What do you make of Scott's take that the market wants to bubble up to 2,800 maybe and beyond?
Yeah, I think a few things have shifted since the downturn since December 24th lows. The first and foremost is the Fed. We've seen a little bit of a 180 from them. It's not only the Fed, though. It's global central banks. We saw the Bank of Australia. We saw the Bank of India, the Bank of England, all, the Australian and Indian banks surprising on rate cuts. Obviously, the ECB is probably on hold now, and Chinese central banks are in stimulus mode. So, we're seeing this background now where really what's driven the markets over the last 9 years has been low rates, has been central bank liquidity. Perhaps that's the background we're in once again. The other couple shifts we've seen, Chinese economy had been almost falling in free fall format. They've stepped in an aggressive way. And there's been a bit of a lag impact, so we're waiting to see real effectiveness of that, but hopefully that comes through in the second half of the year. And then finally, the China-U.S. trade deal. December 24th, a lot of uncertainty. As we're getting closer and closer, a lot more positive rhetoric. So I do see the background being a little bit more benign for equities. That being said, stocks don't go up in a straight line forever.
Yeah, Lamar, I'm sorry, pardon me. Lamar, so how do you weigh it, right? You've got the trade talks, which could end up positively. And then you've got this weak economic data. How you match it together, what does it mean for the direction of stocks?
Well, the data, I would say, is not overwhelmingly negative. We've seen some pretty positive results. But what I would say is there's a tendency to look and say, wow, year to date, we're up 11%. This is unsustainable for the year. But we sort of point out that over the last 12 months, over the last year, the market's not even up 3% in terms of the S&P. So while things have looked incredible so far in 2019, when you take a little bit of a step back, all we've done is correct for some of those fears. So I think there's still some room on the positive side. Now, yeah, we do have the March 1st deadline with the U.S.-China talks, which may or may not be a real deadline. We'll kind of have to wait and see on that. But we think I'm sorry.
Sorry, finish your thought, Lamar. Sorry.
Oh no, I was just going to say, barring a discovery that is a real hard deadline and that they don't get anywhere, which we would be surprised. I think we still have some room for some positive returns for the rest of the year.
How poetic would it be if we got a deal on China and then the EU comes along? These reports on Bloomberg this morning that they're preparing a retaliatory draft document targeting Caterpillar, which did slip in the pre-market. Are we just going to trade one dispute for another?
Right. I think the overarching trade deal that the market's looking at is U.S.-China. Keep in mind, China, not only 15% of global GDP, but about a third of growth. Similarly, for the U.S., makes up about 20-25% of global growth.
So you'd rather have the European dispute?
Yeah. If I had to choose one, I want the U.S.-China trade deal to go well. It sets the tone not only for these two regions, but for Europe as well. So I think that's first and foremost. The Europeans don't want their tariffs increased. Clearly, they're already in a state of economic almost crisis. This would only exacerbate that. So I think they are going to push back hard. But on the other hand, President Trump does not want to necessarily rock the boat too much. He is starting to campaign for 2020 elections. There's no need to create unnecessarily volatility around the globe. So,
Lamar, does the market deserve to be where it is? And I ask you that. So we had this big rebound because of the Fed pivot. You're still looking at a potential earnings recession. And here we are, not all that far away from all-time highs. Do we deserve that?
I think we do. I think, you're still seeing, obviously, the full benefit of the tax cuts baked into to earnings. We're seeing, we're at full employment. We're seeing a lot of positive news out of our stocks. Now, some of the economic indicators, as you pointed out, showing some weakness. But we're still seeing on the company level, we're still seeing positive results. So it's not, the growth in the market really hasn't been driven over the last year by multiple expansion that would cause us, a lot of concern. It's really been driven by performance of the underlying stocks. So from here, we feel comfortable about where the market is. I don't think we're looking for, the rest of the year to compound what it's done so far. That would be incredible and, highly unlikely. But yeah, we think it is where it deserves to be and has a little more room for this year.
We've been asking people, if we get a relatively comprehensive deal on China, would you rather own U.S. stocks, non-U.S. stocks, or copper and oil?
Yeah. Well, it's funny. This year in U.S. markets, we've seen industrials, energy, and technology really drive this rally. Those are all kind of levered to this U.S.-China play. If the deal goes well, they may be poised to do better. But perhaps we'll see a little bit of rotation after that. A little bit of a sell the news, and we get into more of the healthcare and the staples that have been lagging a bit. But from your global question, I think we've been talking about a barbell approach. On one hand of that barbell is the U.S., still the best on the block from a developed market perspective. On the other hand of that barbell remains China and even selective EM that are poised to do well.
Well, they're outpacing us this year?
They're completely outpacing us. And actually, there's an interesting statistic. The last 3 times since '05, when China's price to book dropped below 1.4 times, which it did last year, the next 12 months, you see actually a 50% plus rally. So, maybe we're not going to get that, but it's, we're set up from historical perspective to do pretty well in that region.
Lamar, one of the interesting questions is how much of a trade deal positive outcome is in the market, given the rally that we've had. And you've had a good debate this week on many corners. And JP Morgan and Bank of America, Merrill Lynch took opposite sides of that this week. What do you think?
Well, we think, certainly we've seen, especially, we own a couple of semiconductor stocks, which we've seen really recover very nicely so far this year. But I think they still would still bounce a pretty good bit if there was a satisfactory deal on the table. So I think, yes, the market is expecting that there's a good chance that we see a resolution. But if once one is announced, I still think you'll see a bounce. There'll still be some positive impact from that.
Yeah, agreed. I think, a positive deal, especially if it's a little bit more comprehensive beyond just the trade imbalance. I think the trade imbalance deal is priced into the market. Getting a little bit more comprehensive, maybe a bit of an upside. So.